5 critical ETF terms every investor must know. If you're getting into ETF investing, it can feel like stepping into a room full of acronyms and financial jargon designed to make things sound far more complicated than they actually are. Most people pick an ETF based solely on the ticker symbol or the broad index it claims to track. They see S&P 500 or total stock market, click buy, and assume all funds tracking that index are identical. But if you don't know what the core terminology pertaining to a particular ETF means, then small hidden costs, structural inefficiencies, and liquidity traps can quietly shave tens of thousands of dollars off your investment returns over time. As such, it is important that you understand the terminology associated with ETFs, starting with 5 critical terms you need to master if you are looking to invest in ETFs, and start to understand the documentation and information that is being provided as to how those ETFs work, what are the operational costs, and what are some of the red flags to look for. Let's start with the metric that impacts your wallet directly every single day: expense ratio. The expense ratio is the total annual fee charged by the fund management company to operate the ETF. It covers everything from management salaries and compliance legal costs to administrative operations, marketing, and portfolio rebalancing. Instead of sending you a bill or charging your bank account directly, this fee is accrued daily and automatically deducted from the fund's net assets, subtly reducing the ETF's overall return relative to its underlying holdings. Expense ratios are expressed as a percentage of your total asset value. For example, if you invest $10,000 in a broad passive index ETF with a low expense ratio of 0.03%, you are paying just $3 per year in total management fees. However, if you invest that same $10,000 in a specialized or actively managed ETF with an expense ratio of 0.75%, your annual fee jumps to $75 for every $10,000 invested. While a fraction of a percent might sound insignificant on paper, compound interest works in both directions. That extra 0.70% in annual fees doesn't just subtract $70 each year, it deprives you of the compounding growth that those dollars would have generated over decades. Over a 30-year investing horizon, high expense ratios can easily consume 15% to 20% of your total wealth potential. When evaluating expense ratios, always benchmark the fund against direct competitors holding similar assets. For broad index funds, anything below 0.10% is exceptionally low, while ratios above 0.50% require strong justification, such as complex exposure or proven active management alpha. Next up is AUM, or Assets Under Management. AUM represents the total market value of all financial assets that an ETF currently manages on behalf of its investors. It serves as a definitive operational health check for the fund, reflecting market adoption, institutional confidence, and economic viability. When an ETF boasts billions of dollars in AUM, such as massive core funds holding hundreds of billions, it signals robust liquidity, tight price efficiency, and high investor trust. Institutional market makers actively arbitrage large funds, ensuring smooth daily trading operations. Furthermore, a massive AUM guarantees that the fund sponsor is generating substantial revenue from management fees, ensuring the fund remains highly profitable to operate. Conversely, funds with low AUM present distinct structural risks. If an ETF maintains less than $50 million in AUM after several years on the market, it is likely unprofitable for the issuing firm to run. This puts the fund at a high risk of liquidation. If an ETF closes, the fund manager sells off all underlying securities and distributes cash to shareholders. While you get your principal back based on the fund's fair market value, a forced liquidation can trigger unintended capital gains taxes if held in a taxable brokerage account, forcing you to pay taxes on accumulated gains years before you plan to rebalance your portfolio. Always check a fund's AUM growth trajectory. A growing AUM reflects sustained market interest, whereas stagnant or declining AUM under $50 million is a sign to exercise caution. Term number 3 is NAV, or net asset value. NAV represents the actual intrinsic mathematical worth of a single share of an ETF. It is calculated by adding up the total closing market value of all securities, cash, and receivables held inside the fund's portfolio, subtracting any operational liabilities, and dividing that net figure by the total number of outstanding shares. The fundamental difference between traditional mutual funds and ETFs lies in how and when trading occurs relative to NAV. Mutual funds recalculate NAV once per day after market close, and all buy or sell orders execute at that exact single NAV price. ETFs trade continuously throughout the day on open stock exchanges, just like individual stocks. Because ETF share prices fluctuate in real time based on supply and demand on the exchange, an ETF's live trading price can temporarily detach from its official underlying NAV. When an ETF trades higher than its underlying holdings are worth, it is trading at a premium. When it trades lower than its holdings, it is trading at a discount. Fortunately, specialized institutional entities known as authorized participants, APs, continually monitor these gaps. Through an arbitrage mechanism called the creation and redemption process, APs buy cheap underlying stocks and convert them into new ETF shares when a premium exists, or destroy ETF shares to claim underlying assets when a discount appears. This ongoing institutional arbitrage keeps the live market price tightly aligned with the fund's NAV under normal market conditions.
That brings us to term 4, the bid-ask spread. Whenever you place an order to buy or sell an ETF on your brokerage platform, you are interacting with two distinct prices. The bid price is the highest price a buyer in the market is currently willing to pay to purchase a share from you. The ask price, or offer, is the lowest price a seller is willing to accept to part with a share. The difference between these 2 points is the bid-ask spread. It functions as an explicit trading transaction fee that goes directly to market makers for facilitating liquidity. For example, if an ETF has a bid of $100 and an ask of $100.02, the spread is 2 cents, or 0.02%. Highly liquid, massive ETFs that trade millions of shares daily boast ultra-narrow spreads like this, making trading friction practically zero. However, for niche ETFs, such as those focusing on emerging markets, small-cap international companies, specialized commodities, or low-volume thematic trends, the spread can expand significantly. A spread of 50 cents on a $50 share equates to a 1% immediate loss the moment you execute a trade, meaning the asset must appreciate by 1% just for your position to break even. To protect yourself against wide spreads, 1. Pay attention to total trading volume alongside spread percentages before placing orders. 2. Avoid placing market orders, which execute immediately at whatever ask price is available. 3. Use limit orders, which allow you to set the maximum price you are willing to pay or minimum price you will accept, preventing accidental execution during temporary spread spikes.
Finally, term number 5 is tracking error. The vast majority of ETFs are passive index funds designed to replicate the exact returns of an underlying benchmark, such as the S&P 500, the Russell 2000, or a global aggregate bond index. Tracking error measures the standard deviation of the performance difference between the ETF and its target index over time. In a theoretical world without friction, if the S&P 500 gains 10% in a year, an S&P 500 ETF should gain exactly 10%. In reality, perfect replication is impossible due to several practical operational factors. Expense ratios. The baseline fee immediately creates a small drag on performance. Dividend cash drag. Funds accumulate cash dividends from holdings before distributing them to shareholders, causing minor performance lags during rising markets. Sampling strategies. ETFs holding thousands of illiquid international securities may purchase a representative sample rather than every single stock, introducing slight variance. Rebalancing transaction costs. Buying and selling securities within the fund to match index shifts incurs internal brokerage and trading expenses. A low tracking error demonstrates that fund managers are executing tight, highly optimized portfolio management that minimizes internal costs and closely mirrors the benchmark. A high tracking error indicates structural inefficiency, revealing that the fund is underperforming its stated objective beyond what can be explained by its expense ratio alone.
To wrap up, evaluating an ETF requires looking far beyond its name or historical chart. Before deploying your capital, evaluate these 5 operational fundamentals. Expense ratio to control ongoing annual fee drag. AUM to ensure long-term fund stability and prevent forced liquidation. NAV to understand intrinsic asset value versus market price. Bid-ask spread to eliminate hidden transaction costs at entry and exit.
tracking error to confirm you are getting the exact benchmark returns you paid for. Understanding these 5 metrics will assist you more effectively analyze the potential of particular ETFs. Thank you for watching.